Josh asks, if you were to restart today at age 30, what would your 401k and Roth IRA portfolios look like? What funds and what percentage? And then another question that was incredibly intriguing from Matt. He asked, funds such as VU, QQQ, SCHD make most of their appreciation from their top 10 holdings, and then the rest of the holdings in the fund tend to drag the fund down. If you were to just hold the top 10 holdings in each fund, it would mitigate the problem and you wouldn't have to pay a fund fee. Then when the funds rebalance, just copy what they do and you're good to go. Is this a foolish strategy? Solid questions from both of you. Let's discuss. I'm Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. Both of these questions can get incredibly complicated with all the information out there. So let me try my best to simplify this so that you can invest to the most optimal of your goals. Let's start with Matt's question about the top 10 holdings and that strategy. In VU, or the S&P 500, you can check the holdings and see how much of each company is actually allocated within the fund as a whole. The S&P 500 is market cap weighted, which just means that there's more of a certain company based on how big it is compared to the rest of the companies that we have in the United States. So for example, there's going to be more of Apple or Microsoft than there is of this company called Zebra Technologies Corporation, which I think is a good thing. Anyway, when you go to the portfolio composition and look at the section that says percentage of the fund, we can see exactly how much of the S&P 500 each of these top 10 companies has. Apple makes up 7.67%, Microsoft makes up 6.77%, Amazon makes up 3.11%, and so on. The top 10 companies here make up over 30% of the S&P 500. Think about that. With the S&P 500, you're getting 500 companies in your basket, but the top 10 of those 500 makes up 30% of the entire thing, meaning that the rest of that 70% is split up between 490 companies. That seems crazy. When we look at QQQ, which is a growth fund, it's very similar with their top 10 holdings. Apple's at 10.97%, Microsoft's at 10.24%, Amazon's at 5.19%, Nvidia 4.19%, and Meta at 3.78%. Their top 10 makes up 48.45%. That seems even more crazy. So the top 10 in this fund basically makes up half of the entire fund. So Matt's question was valid because he's saying, shouldn't we just invest in those top 10 anyway? Because one, they're the ones that we care about anyway, and they're the superstars that are bringing up the entire fund. Two, we have to pay a fee to invest in this ETF, whereas if we just buy the individual stock, we don't have to pay any fee. And three, the rest of that fund is just companies that we don't even care about, like Zebra Technologies Corporation, and it's pulling down the fund overall. So should we do this? Short term, yes, I do agree that holding those top 10 companies is the smart thing to do. Very, very short term. Right now, they're the top ones, they're the best performing. So yeah, that would be great to own those top 10 right now. But we all know that these top 10 are not gonna stay the top 10. Even Matt knows that these are not going to stay the top 10 because he asked in his question and said, when these ETFs move their top 10, shouldn't we just follow what they do and move with them? For example, right now the biggest companies are heavy tech like Apple, Microsoft, Alphabet, Google, Amazon, and then there's Berkshire Hathaway and United Health. Just 20 years ago though, in 2003, the whole landscape looked drastically different. The top companies then were Microsoft, General Electric, Exxon, Walmart, Citigroup, and Pfizer, among many others. In 1990, it was even more crazy, with companies like Exxon, IBM, Merck, Bristol-Myers Squibb, and Coca-Cola. So if we were to follow this strategy and just hold those top 10 companies and watch when they're going to move, first, you'd have to be very active and be watching and researching so that you can make your moves quickly when they make their moves. Second, let's talk about what it actually looks like to make those moves. In order to go from a certain group of 10 stocks to go to a different group or to add new ones in and take old ones out, let's say for example you want to take 2 of the companies out because they're underperforming and move 2 new companies in because they're doing great. What you actually have to do is go in and sell the shares of those 2 companies and then buy new shares of the two new companies. In a brokerage account, if you do that, when you make that sale, you're actually going to have to pay taxes on whatever gain that you made on those companies, even if you're going to be investing that money directly back into the brokerage, directly back into two new companies. So you don't even get to use that money, but you have to pay taxes on any of that gain. That's the first con. The second con is the timing. If you're adding in these two new positions, it's because they've increased their market cap and are basically crushing it, so much so that now they're in the top 10 of the S&P 500. This means that at this point, their price, their stock price, is probably at the highest that it's ever been, or at least very, very high. And so statistically, this is absolutely the worst time for you to be buying into that stock. And then those two that you would be dropping out in order to make room for the two new are probably doing the opposite. They're underperforming, which means their stock price is down, which means this is a terrible time for you to probably be selling these stocks. So you're selling those stocks at a bad time, you're buying the other ones at a bad time. Overall, this is going to hurt your portfolio if you keep doing this long term. In theory, just holding the top 10 stocks seems like the move, but practically, that's just not how it works. The way that you actually get to continue to always hold the top 10 stocks is by investing in a very solid ETF and just letting them do the work for you. Yes, it's only 30% of VU or 50% of QQQ, but it's always going to be giving you that top 10 and you'll never have to do any of the work, and you won't be taxed in order to have to buy and sell to keep your portfolio in a place that's going to be favorable for you. So now going to that first question. If I were to restart today at age 30, what would your 401k and Roth IRA portfolios look like? What funds and what percentage? Honestly, they'd look like very similar to what they already look like already today for me personally. But if I truly was starting from zero today, literally at the end of October 2023, I'd have to keep in mind the investing landscape and what the market looks like and the economy in general today. SCHD is down about 11% for the year. VU is up about 8% for the year, but down 3.6% for the month. Growth funds like QQQM are super high this year to date, up over 30%, but they were down last year in 2022, about negative 30%. So looking over the past 2 years, we're kind of in the same area as we were in 2021. So I don't think we're as overvalued as some may say. I'd still have a core of these 3 ETFs that I believe are the most important ones for your portfolio, no matter what fund you're going to be putting them in. That would be a foundational ETF, a dividend ETF, and a growth ETF. The biggest sale and value in my mind today at the end of October of 2023 is going to be the one that's beaten down the worst and down the most, because now you can buy in at a favorable price and wait for that thing to keep growing, and that'll just be your best bet for overall value. Today and right now, for us investors that are already investing in it, it is kind of frustrating, it is kind of boring, and any of those funds that don't have much technology or AI exposure, they're probably not doing great. And so ones like SCHD look like they're doing worse than they actually are compared to the other ones that are doing really, really well. But SCHD would definitely be the one that I would be putting most of my money into today. I love that dividend growth long term, and my goal is to have passive income forever. I'd go about 50% of my portfolio there today. Then I'd split the rest evenly, 25% in VU and 25% in either QQQM or SCHG, or possibly VUG. And that would round out my 3-fund portfolio. For more info on why this new 3 ETF portfolio is literally the best thing out there, and why so many people have made this their investing strategy of choice long term, check out this video where I go way more in depth on each of the 3 funds and why those specific 3 funds compared to other things that in the past have done pretty well. And I tell you exactly how much percentage to do based on the age that you are and your overall goals. Watch that video now and let me know what you think in the comment section.